All right, so we're going to go over how to transition from typical mortgage protection over to equity protection. So if somebody's too old or they're too sick or something and they're expecting to get their entire mortgage covered, how you transition from covering the entire $200,000 mortgage to getting him a $20,000 or $30,000 policy to protect the equity. All right, so when I first started, I had a lot of difficulty with it, and then just repetition. Listening to trainings and whatnot, I kind of tailored something that has been really successful for me. So my in-home is going to be basically identical up to the financial inventory sheet when I'm doing mortgage protection or equity protection. So after I tell them what we're going to do and why I'm here and the whole shebang, we get down to the financial inventory sheet. And so when I fill in this out, and I'll just role play with you, and then I'll just do it like real life. So
okay,
we get to that last end. So I'm assuming this is a mortgage, right? You don't rent?
Yeah, this is a mortgage.
All right. 30-year mortgage, I assume?
Yep, 30-year.
All right. And do you know what the house is valued at? So if you were going to sell it tomorrow, what you might get for it?
I think it was valued at about $250.
$250. Okay. That's pretty good. All right. And so you have about $70,000 in equity right now in the house. So that's really good. All right. And so the equity is obviously the part that we really want to protect. We want to make sure that God forbid something happened to you, whoever's left behind, so your wife is not going to lose the house, right? We want to make sure that if she needs to sell the house, worst case scenario, she's able to sell the house and pull that big $70,000 out. That's where the big payout's going to come from.
Right.
That makes sense?
Yeah, definitely.
All right. So what's your monthly payment for the house right now?
It's about $1,580.
$1,580 a month. Is that escrow, so property taxes, all that in there?
Yeah, that's everything together.
All right. And are you paying anything extra towards the house right now to pay it off early?
We plan to, but not right now. No.
Yeah.
We haven't
I always tell people. I mean, the bank has enough money, right?
Yeah.
You can keep some money in your pocket, do it. All right. And how old are you?
I am 27.
Well, for the sake of this
I
video,
am 77.
77. All right. 77 years old.
Right.
All right. And your date of birth, I think you said it was April 19th, right?
Mm-hmm. 1943.
1943. Okay. All right. Are you retired? You're still working?
I'm retired.
You're retired, living the good life?
Oh, yeah.
I like that. One day I'll get there. It's my goal anyway. Monthly income after taxes?
It's about $3,000 a month.
$3,000 a month. Okay. And is this coverage, are we looking just to cover you or for you and your wife?
Just for me. I think if something happened to me, I would want her to be able to take care of things.
Okay. And does she have any income coming in right now?
She gets her Social Security, so it's about $2,300 a month.
23. All right. And are you on any medications?
I just take some medication for some high blood pressure, cholesterol, and I've got diabetes. I just take the pill.
Okay. So the big three. Just everybody has those.
Yeah.
All right. So high blood pressure, cholesterol, and then metformin.
Yes.
All right. And then were you prescribed anything the last 7 years that maybe you're just not taking, but you were prescribed?
No, not that I can
Pain
think
meds,
of.
nothing like that?
No.
Okay. And do you smoke?
No, I don't.
Okay. Good answer. Good answer. So you're not going to believe what that does to a premium. So I was just sitting with somebody the other day, same age as you. I think they were actually 76, so maybe about a year younger. And we were looking into some protection. We ended up doing what's called equity protection because just because of their age and everything and the medications they were on, we wanted to keep the price reasonable. So we were looking at, they paid, I think it was right around $1,000 a month. So we wanted to protect like 18 months worth of time. So it was a female. She was a smoker, right? And we wanted to cover her for $18,000. As a smoker, I ran that $497.
Oh, gosh.
$497.
Yeah,
right?
no.
So then I ran non-smoker rate. Guess what it was? Guess what the difference was?
Well, it was like half or something?
Dude, $497 down to $263.
Wow.
Isn't that something?
Yeah.
Isn't that something?
Smoking's not my thing, so.
Good. Because that just jacks you up. Any major surgeries for you? So any like heart surgeries, organ transplants, anything like that?
No.
All right, and so family. So this is who are you trying to protect with this coverage, or who's your beneficiary going to be? Is it going to be your wife?
It's going to be my wife.
Okay, your wife. And what's her name again?
It's Margaret.
Can you spell it for me?
Margaret.
All right, and that same last name as you?
Yes.
All right, so Barrett.
Yep.
Barrett.
Mm-hmm.
All right, so to make sure I have the spelling right, to make sure that she actually gets the money.
Right.
You know.
Yeah.
So all right, perfect. So got that. This we already went over. Now, do you have any kind of life insurance currently in place? So something that you privately own?
We don't.
You
No,
don't?
I have nothing right now.
All right, so let me just look this over real quick. All right, so mortgage, you have about $70,000 in equity, so we really want to protect that. $1,580 a month. All right, perfect. So now, what most people do in your situation, instead of covering the entirety of the mortgage, so the full $180,000, which it's astronomically expensive at your age, as well as the medication. So what most people do in your situation is we look at what's called equity protection. So what we want to do is we want to make sure that, God forbid, something happens to you, that Margaret is able to continue making the mortgage payments for a period of time, right? That she doesn't have to try to come up with additional funds immediately after your passing or anything like that. So basically what we want to do is put her in a situation where she can really adjust to losing your income. And so she only has about $2,300 right now coming in, $1,580 going out just for the mortgage. So she's still gonna have to pay things for like groceries, electric, sewer, water, the whole nine, right? Mm-hmm. Gas, all that stuff. So we really want to protect a period of time, and God forbid, and let's just say we do 12 months or 18 months worth of payment protection. If she does end up having to sell the house, she's able to sell the house, and that's where that big payout's going to come from. That's when she's going to withdraw that $70,000. Or if you live another 10 years, it's going to be significantly more than that, right? So that's where the big payout's going to come from after she sells the house, if she has to, and that's going to give her time to list the house, find another place to live if she needs to, and like I said, take that big payout when she actually sells it. All right, so what we'll look at, do $1,580. We'll look at about 12 months and 18 months worth of coverage, and we'll see what that comes out to. So we have $1,580 times 18, so $28,440 is going to be one. Say it was.
Is that 1,580?
1,580. Yeah. Okay, so 1,580 times 12, so 18,960. All right. So now at this point, I would just run the premiums.
Sure.
Right? So let's just say 28,000 is I don't know, 294. Let's say. So I'm going to write 294 a month under option one. And I'm also going to write down the face amount, so $28,440. And then I'm going to write down terminal, $28,440 plus cash value. And then accidental death, $28,440. Do the same thing with option two. So I write down the face amount, $18,960. Write down terminal, $18,960 plus cash value.
So the same thing. You don't have to write the whole thing out if you don't want to.
Too late. I already did. 960. And then the premium. So let's just say this is $194. Okay. Go ahead.
I was just gonna say I really like that approach as far as like the way you're showing it is like you're paying this monthly premium to get that equity at the end of it.
Yeah, right.
So instead of just being like, well, yeah, because what I run into sometimes is people are just like, well, they kind of give up hope sometimes if they're a little bit older and they can't cover the full amount, or if they've got health things that prevent them from that. So that's awesome. That's really good. I'm going to go back and watch this again just so I don't miss anything because it's really good.
Yeah, no, I appreciate it. This has worked really well for me.
Yeah. I can see why it would, because if they've got equity in the house, which they're probably going to have, I mean, they've probably been there a while. Yeah. Usually if they're around that age bracket, 70 and up, and they don't want to lose the equity in their house. So that's great.
Yeah, and they're expecting a big payout to pay the mortgage off, right?
Right.
When you first enter the house.
Yeah, so that is the payoff. Now you've changed that to, hey, you're still going to have that.
It. Yeah. You're still getting it.
And you're not going to lose that.
Right. And not only are you getting it, and I sometimes bring this up too when I'm pitching it, is when I'm going over the equity protection, I'll tell them that we're going to provide enough payments to keep her from having to come up with additional means to make the mortgage payment. That way we can keep the bank's hands off of it. We don't want this being foreclosed on. If someone's going to get the money, it's going to be her. It's going to be the wife. And this is a way to ensure that it is her and it's not the bank, and they stay out of it. All All right. Like we already discussed, they already have enough money,
Yeah.
you know? So, and then when I show them this at the end, when I give them the options, so option 1 and option 2, there's not the same living benefits like there is with term.
Sure.
So what I did is so with term, we have critical, chronic, terminal, sometimes accidental, sometimes cashback, right?
Right.
With final expense, we have terminal illness, and that's really it as far as living benefits.
Mm-hmm.
So then I put a lot of emphasis on the cash value and then the accidental death benefit. So
can you go through the cash value?
Yeah, so that's what I'm going to do. So once I finish writing this down, I say, all right, so I have a couple different options that I think would make sense for you. So option number 1, looking at $28,440. This is going to give her enough money to continue making the mortgage payments for a period of 18 months. Okay, so $28,440. This is going to be $294 a month. And now, where this policy has a lot of its value, obviously, it's going to pay out the $28,440 if you die. It's also going to pay out if you were to get terminally ill. So in Texas, terminal illness, it's anytime you're diagnosed with 2 years or less to live, that's going to be considered terminally ill. If that were to happen, you become the beneficiary, and they're going to pay you out 100% of that $28,440. Okay. Now, you also have a cash value account. I don't know if you're familiar with cash value. Some people are, some people aren't. But basically, what that means is every time you make a premium payment, it's going to accrue interest, right? And so let's just say in 5 years, 10 years, 11 years, right? You have $5,000, $6,000, $8,000 in the cash value account. You can either take that money out of the cash value account. You can go buy TV, or a couple cars, dogs, whatever you're into, right? Or you can leave that money in there, and you can actually use the money in the cash value account to pay the premium. So it's like a self-funding account. So that's a pretty cool feature that these things have. And now you also get an accidental death benefit rider included in this. So you're not paying anything additional for it. They just give it to you. So if you were to die by anything other than natural causes, so car crash, you fall, hit your head, you hit by a bus, right? Anything not natural, they're going to double the payout. So they would pay an additional $28,440 on top of the original $28,440. Okay.
Oh,
so
they added that on.
Yep. So they added on. You don't pay for it. They just throw it in there.
Okay.
So that's option 1. Option 2, looking at $18,960. This is going to keep the mortgage payments in place for a period of 12 months. This is going to be $194 a month in exact same living benefits as option number 1. So terminal illness, you're going to be covered 100%. So if you get terminally ill, they're going to pay you out the full $18,960. The cash value account is also included in this. So like I said, you can go buy some dogs or whatever, or you can use that money to pay the premium itself.
Okay.
And of course, they give you the accidental death in here. So they would double the face amount or the payout if you were to die by anything other than natural causes. So an additional $18,960, right?
Okay.
So now, out of these two options, what one do you think would make the most sense for your situation?
I'd like to do the first one, but budget-wise, I think the second one would probably be best.
Yeah, so I think that makes sense. So my job is to make sure that we find you coverage, but we need it to be affordable. The last thing that I want to do is walk out of here and have this dramatically impact your life. Like you're not able to go out to dinner with your wife anymore or anything like that. So what the goal is to find you the most amount of coverage that we possibly can, while it's still being affordable for you. So I think option 2 makes a lot of sense. All right, so that's what we'll request the coverage for. And now again, so what they're going to do is they're going to run your prescription history, your medical background. They want to make sure that you are really who you say you are, right? All right, so if you don't mind, can you just grab me your driver's license? And as soon as they start moving, voided check. And then if you don't mind, if you could just grab me a glass of water or something. I've been talking all day. My mouth's started getting dry. Yeah, I appreciate that.
Yeah, that's awesome. I really like that. I like that you put the additional cash value and accidental benefit on there, because I haven't been doing that.
Yep.
And it's like it's naked. It's like something.
It's naked. It looks boring.
It does. It's like
that's what I did in the beginning.
Yeah. So I like that.
Yeah, because the reason why I do this is because when you pitch term, most of what you're pitching are the living benefits.
Right. You have all those. Yeah. Exactly.
Yeah. So it's like they already expect you to come in there and be able to have a death benefit. They already expect that. So they're already expecting to pay a certain amount of money for a death benefit. Very, very rarely are they expecting to get all of these additional features with it.
Right.
So I put more emphasis on the additional features than I do on the death benefit, because these are additional things that they weren't even expecting to be on here. So it just makes this number, the 294, the 194, appear that much more attractive. They can understand why the price is what it is.
Looking at it on this side, I feel like I'm getting more because you've laid that out. And then I want to be like, okay, yeah. Like I want to say yes to you.
It's easier.
Yeah,
it's easier.
Definitely is.
You get more bang for the buck. So
for sure.
Yeah, that's it, man. Equity protection.
Cool. Awesome. Thank you for that.